Now, next up for Team USA is Jan Svenda. Kim came over, was a Spanish member of the Team USA, and now we have a European member. And Jan, he also works aside me as my analyst in my companies. So he's here to present PXHI. I own the stock. I'm going to disclose it up front right now. So Jan, take it away, man.
Thanks, Maj, and thanks, Bobby, for having us. I would also disclose that I'm long Phonex, and I'm going to be talking about today why I feel that the stock has really good potential in the next year or so. The usual disclaimer. Now, right into the company description. So basically, what Phonex does is that they have this we sell cellular business, which is basically a business focused on secondhand phones. So they source secondhand phones and then they sell it. Pretty straightforward and easy business. Really nothing much more to it. They've been trying to do it B2C initially, but now they're just doing it B2B. Basically, they source hundreds and hundreds of iPhones and Androids and Samsungs and help businesses that need that quantity of phones. They have this kind of platform, and they've been also trying to develop a software that they can sell to some other providers of such services. Really straightforward business, nothing much more to it. You can think of it as kind of this liquidation services, where basically you have 100 laptops from company that might not need them anymore. And basically someone's looking for 10 or 20. So they kind of split it up. So that's kind of the basic thing here. It might really seem simple, but it has staying power. I mean, especially in the days of supply chain restrictions and so on and so forth. I mean, a lot of people need access to inventory, and that's been really something that has been beneficial for Phonex itself, because they've seen really strong trading, strong growth of revenue and gross profits as well. So there is that supply chain side, which helps the whole thing. And we've also seen, of course, a strong trade-ins, which are very important for the stock itself, for the business. So basically, for iPhones to be, traded in, that's very, very important for the business. That's been happening. And there might be some industry trends that, might eventually, commoditize the business a bit, or, make it a bit less exciting from the growth perspective. But right now we're not seeing that. And in any case, the bottom line is that it's such a simple business that it has great staying power, and, people start to rely on diesel cellular a lot. So therefore I'm not afraid that, it would be really a victim of quick success, whereby the others start to eat into the market share and so on and so forth. So that's kind of important to note about the business description itself. Then basically what is interesting, why we're highlighting it right now, is that the stock hasn't been moving much in the past 9 months, almost a year, while their numbers are just on fire. They are really growing sales. They have about 101 million in 9 months. The thing is, of course, that the gross margin here is pretty low. So, the gross profit ends up being only 11 million. But when you look at the growth numbers, sales are increasing, gross profits are increasing slightly more, which is even better. So you're looking at a company that is able to grow, but they've been able to grow at scale, and they run a pretty lean organization. Their cost structure is very simple. They don't need any fancy salespeople and so on and so forth. They don't need really a complex structure to make it work. They already have a very well-run machine, and so they're actually able to get some scale, some benefits of scale, and then they are able to be profitable, by a lot. The net income is about 4.6 million 9 months. We can assume 6 million for the whole year, which is going to be important when looking at the market cap. What is also interesting, and I'm just gonna see, just for you to understand the valuation, since I talked briefly about it, with the current share price, which is about $1.20 now today. But it is resulting in really attractive numbers. PE is just about 6. EBITDA is 6 million in the past 9 months, and if I assume 7 million EBITDA, which is very conservative because they've been able to grow almost each quarter, and there's nothing that would show that they should slow this growth down. EBITDA is about 4 times. That's really assuming the 7 million EBITDA for the whole year, which is conservative. So you're looking at, in the valuation perspective, you can kind of look around the stock from all sides and kind of come up to the conclusion that it's very cheap. Also, they don't have as much tangible book, or they don't have much assets, let's say, apart from cash, because of course they're churning out a lot of cash, but they have no debt now, which is really important to say. So even though the evaluations that I've looked at here are mostly profit driven, the balance sheet is very solid as well, and they've been trying to really make sure that they don't have any sort of financing risk, and they don't need to raise any money. They just basically keep on running the business as is. The other part, so you have a pretty straightforward business that is really well operated, growing each quarter, without too many issues. You also have a very aggressive management team, which is trying to basically repurchase as much shares as possible, which is of course a double-edged sword here, but we believe that it does show the confidence of the management team in the company. The insiders that are kind of noted in the filings own roughly about 74% of the stock, which makes it relatively illiquid, but there is a volume out there on a daily basis. It's not that it wouldn't trade every day or so, and there's about a couple of grand each day at least, and some days on the earnings it can go quite up quite well. So they own a lot. So I think they are very aligned with the success of the whole operation, and they want even to own more. They bought back about 8.2 million shares in the past 2 years. The company had about 40 million shares, so it's really a significant number. If you look at the trades that they've done, they've really bought back about 7 million worth of the stock, which is really insane for a company that is roughly valued at 40 million bucks. So that's really great for us shareholders, because of course we're gonna get more piece of the pie, bigger piece of the pie in that sense, and they seem to really continue to do that quite a bit. So they've been using that cash flow to repurchase shares, and we're not talking about Amazon here, who they can announce a 10 billion stock buyback, and you're looking at maybe 1% of the company or whatever it is. Here you're looking at 20-30% of the company being bought back, which is really aggressive and really positive of course for the valuation itself. So the management team, I think, believes in the story. They had basically ability to a part of the insiders had ability to convert their preferred shares. So there was some debt that they incurred in the past, and the insiders had the option to either get paid in cash or convert it into shares. All of them converted into shares. So again, it's just showing that the insiders are really feeling that the growth can continue in this way, and they want to own a lot of the company. Also, quite a few things point out to a possible buyout. Really, they discontinued their credit line, which is fair enough. Like you're running such a smooth operation in terms of the cash flow that you don't really need it, which is great. So the working capital is really not an issue for them because of the cash that they have on their balance sheet. But you don't usually do that. I think that what they've done it for is really they've been trying to explore strategic alternatives. The proxy in 2020 also talked about a cash bonus in case of sale for the management team, which is really important, and showcases that basically, it's really going to be something that they want to look forward to. And they haven't done it yet, but we believe, that they're looking for it, and especially the buybacks are really something that mention or kind of like showcase that they're interested in doing so. There's the double-edged sword. It could be that the management is going to try to lowball the stock, but we believe that they will still offer a premium. And if you're looking at the valuation again, you're looking at a stock that is very cheaply valued. And even if they are trying to somehow lowball it, they will still have to put up a nice premium. You can see that the stock was 170 at some point, so we're not really super afraid about getting something that would be completely unreasonable. So yeah, I think that summarizes it. You have a simple business that is growing, is well run. Management is super aggressive, super bullish, and you have a valuation that creates a margin of safety. That's how I would summarize it.
Hey, thank you, Jan. That was a nice, concise summary there. And I know the story well because I've owned it for some time, like myself. Also, when I first bought the stock, it wasn't quite as clean yet. I think it was trading around 30 or 40 cents or so. Now, interestingly, you talked about some of the buyback, the trends, but the last buyback I think was actually about $1.20 or so, which hopefully will set a new low for the stock. And I remember, I think it was in 2021, maybe the CEO put out a press release, and the CEO basically is saying in the press release, the public press release, if you want to sell your stock, call me up and I'll buy it from you. So, and the stock was, in the dollar range there. So that's pretty cool. One thing on the gross margins, I guess that's where I think we look at the valuation of the stock and what's the hidden risk here. And I think it's the gross margin area is where people might look at that and maybe not want to give it a high valuation, but they've come up a little, the gross margins have been increasing a little bit. And I think as they position from the brick and mortar, just buying their old business, just buying phones inventory and selling them, to this more software platform of allowing other companies that want to do what they do on a platform. I guess they call it SaaS, a software platform, and finally, I'm not quite convinced yet it's SaaS. We don't know all how they generate the income from that totally, because some of that income is derived from the transaction, right? But I guess that's my biggest concern is, well, can they get gross margins a little higher can they get enough revenue from the software platform to offset, to make it more of a piece of the revenue? And they talk about it growing, but they really don't talk about the size of that business. They don't break it out, so we have no idea, right? What's going on there. And so yeah, that's cool, man. And I think the other risk too, Jan, and I remember we talked about before, is if you go into situations where there's a delay in a release of an iPhone, that delays trade-ins, right? So that might delay the ability to get inventory to sell used phones and stuff. But and that was a lot in their past history. That was some of their problems in the past. These guys have a real crazy history, and that were some of the issues. But yeah, so I think that, what do you see? Like I guess your biggest concern was going private transaction, right? And
yeah, I guess so. But yeah, it's a good concern to have. It's a good concern to have. I think that the business concerns are definitely there. I believe that what the management is trying to do is probably really trying to get to that 90%, or trying to really sell the business, maybe even before the industry trends change, so to speak. So you definitely, there are concerns here about some of the operations. How can they run it? But it's been for 2 years. It's been for 2 years they've been able to maintain this growth and really ramp up the numbers. So it's really, we're not talking about volatility in the quarterly releases anymore. In the past they've been struggling because of like B2C and then B2B. They changed the business a couple of times, and they really found footing now. So it's almost like, yeah, you can definitely have concerns, but at quarter after quarter they just showcase the same thing. So it's a bit harder to do that, but still, over the long term, like 5+ years, for sure there are questions there. Yeah.
And the cool thing is there's no risk of an offering or a kind of dilution, because they're buying back stuff, they clean their balance sheet up. So you have a situation where the company's definitely de-risked itself, right, to some degree. And maybe if we continue to see more margins, or they become more transparent what's going on, we can get up more re-rating the valuation to the upside. So I think it's a solid pick, Jan. So I'm happy that you did this a good job. And I'm not questioning, but
I would say that, like it's really like in my, past 5 years looking at the OTC stocks, day in, day out. I mean, this is a classic case of like someone, a business that is just, real, well run, has some management incentives in the right way. And, therefore you're just like looking at that and people don't really know about it. They might not they might not be aware of it. And it's just going to be, like this maybe for the next year or so, but then suddenly something happens and, it doubles, hopefully.
I wouldn't rule out an uplist, I think the catalyst I think it's either an uplist if they want to stay public or they sell the company. Is what I guess we're looking at too here. So maybe a double, hopefully at the minimum, and see what goes on from there.
Sure.
All right, thanks, Jan. That's been awesome. We've been here with Jan Svenda for Team USA, coming up to us from Europe with a pitch on PXHI. So thanks, Jan.
Thanks, Mike.
Wishing you luck.